Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 3rd of July. I'm Daniel Lam, your host for the podcast. I'm very curious about what is in the mind of Powell, as well as other long-standing Fed officials, ever since Trump got elected for the second term. The Fed officials are very wary of the inflationary effects from tariffs. I believe, so far, they've been extra cautious though, because memories at the end of 2021 and the first half of 2022 must still be in their minds, i.e. the time when the Fed said inflation was transitory. However, is the Fed overestimating inflation this time around? Now we know that the US CPI has been softening a few prints in a row now. Compared to 2021 to 2022, this more balanced labor market now suggests that inflation would be contained. Now Powell did signal that were it not for the uncertainties caused by the tariffs, the path for the Fed to cut rates would be much clearer. Now the market is already positioning for a more dovish Fed. Besides the labor market, the health of the supply chain is also important for inflation. And there the delivery times has been stable globally. Now the June Conference Board Consumer Survey shows rising concerns on labor. And the May US Personal Income and Outlays report showed that real personal spending declined by 30 basis points month on month, missing expectations. Income fell even after excluding transfers, reinforcing a signal from a weakening labor market. So the weak consumption print suggests that hard data is now converging with subdued sentiment measures. This and the more balanced labor market led to falling US 10-year government bond yield since the middle of May. US Treasuries are getting support from the government's recent buyback, and they would get demand from the rotation out of equities should data turn out to be weaker than expected in this summer. Remember that we need to see the US economic data surprising on the upside in order to propel US equities higher. And we continue to be leaning towards the milder camp in the performance of US economic data. So all in all, there could be further room for bonds to get stronger, i.e. for US 10-year government bond yield to be edging towards the 4% level. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.